So I'd like to talk to you about Sable Offshore, which is one of the latest positions that Li Lu has initiated in his Himalayan fund back in Q3. And in Q4, actually, there was no change in this position per the 13F that was released this quarter. So we'll have to see next quarter to see if there's any more changes. Now, a lot has happened since he initiated that position. A lot was covered in my last video when I talked about his position in December of last year. So I'm going to focus this video on what's happening basically in Q1, especially in relation to the earnings going on right now. So in Q1, the company was supposed to do its hydraulic tests, basically a water test to see if the pipelines are fixed properly. That was actually delayed due to the cease and desist order by the California Coastal Commissions. That was actually delayed until February. Moreover, there was actually a vote by the County of Santa Barbara, by the Board of Supervisors, to decide whether or not to uphold the transfer of permits of the pipelines to Sable in February. Now, these two were key events that could have actually derailed the company quite significantly, which is actually, in full disclosure, I sold my positions during the run-up to the board meeting because if it had gone a different way, the company would have been significantly devalued, or basically the risk of it not producing any oil until the end of the year would be quite high. And I think that was a pretty big game over that would have occurred. Now, and you can see with the stock price today, the two events turned out to be not as big a deal, with the Board of Supervisor vote actually coming in at 2-2, which basically means no action is taken by the Board of Supervisors, which allowed the permit to potentially transfer from the previous owners to Sable going forward. Now, the California Coastal Commission's cease and desist order were actually challenged by Sable Offshore in a lawsuit that they actually have shared with the public as well, that you can read up. But basically, it says that they had no jurisdiction to challenge it. That's basically done everything in good faith, and that federally is required to actually make the pipeline safer. So it will continue to work on the pipeline while it challenged the order itself. Now, this is key because they have indicated that they will continue to work on the pipeline to fix any potential issues so that they can start doing their hydraulic tests and move forward with pumping oil, despite the cease and desist order. Now, this will be, of course, be challenged in court, and depending on how a lawsuit plays out, the company could face punitive damages for taking work that is actually not permitted, but which is argued by the Coastal Commissions, or going the company's favor, which then they can sue for punitive damages paid by the commission to pay for legal fees and other sorts. All right, so that's basically what's happened in terms of the key timetable of what has happened in Q1 with the two key events in February. They also received some approvals by the federal, organizations that says that they can actually move forward to fixing the pipelines. Now, the overall backdrop of Trump is actually doing well. If you read some of the articles out there, it shows that Trump is going out there, says drill, baby, drill, and that oil companies are their consumers, which means that there's actually going to be federal support to pump oil from these offshore rigs. And the news around that's making a lot of noise, but doesn't seem to have any material impact to how things are changed, is actually by environmentalists that continue to oppose it restarting, not necessarily to pump oil, but more about a worry about the corrosion in the pipelines. All right. So now that we have kind of gone to review what's happening in Q1, let's really look at what should we anticipate going forward, especially with the Q2, with the Q1 earnings that they just released. Now, I think in the first quarter, the earnings itself is not going to be anything spectacular that we can think about, right? They're going to make a loss because they're going to do all this capex, and because they don't pump oil, they're not going to get anything back. So in this latest update, they basically state that right now they're really close to pumping back oil. They're really waiting for a couple of things, actually 3 things from top of my mind. 1 is the hydraulic test. 2 is the fixing of all the pipelines. And 3 is to get a final approval by the fire marshal that basically the approval to make these fixes or suggest fixes so they can actually restart the pipeline. So basically fix what they're told that need to be fixed and do a test to make sure that everything's okay, and then they can restart. Now that we're very close to restarting in Q2, which I think from the looks of it, I think maybe is going to be May-ish, probably at best. I think when they'll be able to restart. And based on the numbers that they're giving us of being able to pump around 20 to 25,000 barrels of oil per day in the second half, as well as what they think they'll be able to produce in 2026 all the way to 2035, I think. Along with the capex, we could actually start to use a discounted cash flow model to kind of estimate what the value of the company will be in the next 10 years if we just discount the value back to today, or what's the intrinsic value. Now, I'm using a $70 oil idea or pricing for the future, as well as a 10% discount rate. So if I use that, I can see that based on what is given to us, the cash flow X capex and royalty payments, we're actually looking at roughly a $5 billion company by the end of 2035. Now, a $5 billion net present value is actually substantially higher than around the $2.7 to $2.8 billion enterprise value that we have today, which is almost doubling your money. Now, if we continue to expand that a little bit longer, as the graph that they show us actually plateaus more or less, and just extend that for another 10 years or so or more, we start seeing that this can continue potentially be maybe a $7 billion present value company instead of $5 billion, which means that the upside is substantially higher, and it's likely that that's true, right? Because they say that we have all this reserve. They're going to make different capex to be able to drill these oil, and as long as it doesn't spill, the amount that we can generate from this is going to be quite high, right? So if we don't, and the discount the DCF model basically ignores all terminal value. So basically assuming that after this is done, we get no money back. So this actually going to be substantially higher going forward as well. Now, so at 5 to 7 billion, I think we're really looking at a 2 to 3x or potentially 4x return going forward based on the projections that the company has gave us. Now, that's only one part of the equation. The other part of the equation is what if there is a price change in oil? Now, if there's a price change in oil of $1, so a sensitive analysis, if the oil price actually ends up being $71 instead of $70 a barrel, or $69 instead of $70 a barrel, we can really look at a net present value change of the discounted cash flows of about 88 million, which turns out to be about roughly $1 a share, right? So what this all mean is if we look at the $7 billion net present value of the cash flows, we're really looking at about an $80+ share price. And every dollar change in oil, we will get a $1 shift in the share price as well. So that's kind of how I'm looking at it. Now, how do I play it? I think, I've been lucky in the sense that I sold at the 30s and I got to rebuy the shares at a much lower price. Pretty much on accident, well, kind of an accident, because I felt that, the risk was, really big. It should have failed, and I want to protect my downside. But now that, things have cleared, I think rebuilding that position going forward can mean a huge return, right? So at the $5 billion range in the next 10 years or 15 years or whatever it may be, to now, we're really looking at an internal rate of return of around 26%, which is quite high. So I think I'm being able to have my money compound at that rate on average between now and then. I think it's going to be a great investment. Now, how I'll play it, I'll still continue to play it via two options. One is by selling puts. For example, the puts for the 2250 April 17th is actually trading around $1.70, which is probably an 8% return on over a month. So that's definitely how I'll be using some of my cash to sell some insurance policies for others that I'll be more than willing to purchase the company at the low $20 range. The other part, of course, is to rebuild a common stock position where I think the company is undervalued based on the discount cash flow model going forward. Even if you take into account the margin of safety, I think this is a very exciting potential and a great return that we can expect going forward if the company does restart its pipeline, which looks like it will. So my conviction is actually now higher than it was in Q4. Right. So that's all I have on Sable Offshore. I think it's an interesting play. Let me know if you have any positions in the company as well in the comments below. Take care.